Imagine this, you have worked hard, you saved 100,000 Kenya shillings, and you finally decide, I want to invest. Okay? So you open your brokerage account, immediately you see a dozens of company, Safaricom, Equity, KCB, Cooperative Bank, Kenyan, EABL, Absa, Jubilee, Centum, and suddenly a question hits you. How do I know which one is actually worth buying? Most beginners make one dangerous mistake. They look at the share price. If a share costs 12 shillings, they assume it is cheap. And if another one costs 180 shillings, they assume it is expensive. But here's the truth. A cheap share price does not mean a cheap company, and an expensive share price does not mean an expensive company. Professional investors don't buy prices, they buy businesses. And today, I'll show you exactly how they evaluate those businesses. By the end of this video, you will know the 7 numbers that every serious investor should understand before buying any company on the Nairobi Securities Exchange. Number 1, let us stop looking at the share price. Now let me just ask you something. Imagine 2 matatus. Now you're imagining one costs 2 million and the other one costs 3 million. Without seeing them, which one is the best investment? You can't answer that. Why? Because you need more information. How many passengers does each carry? How much fuel do they consume? How often do you or do they break down? How much profit do they make every month? The same principle applies to shares. The share price tells you almost nothing by itself. Instead, you need to understand the business behind the share. That starts with financial statements. Don't worry if you have never read one before. Today, we'll simplify them. By the end of this series, they will feel as normal as reading your M-Pesa statement. So number 1, shareholders funds. Let's start with one of the most important concepts, shareholders funds. Some people call it owner's equity, others net assets, others book equity. All these terms point to the same idea. Here's a simple example. Imagine you own a small supermarket. Inside that supermarket, you have shelves, stock, cash, delivery van, furniture, and those are your assets. Now, imagine you owe suppliers and still have a bank loan. Those are liabilities. If you sold everything today, paid every supplier, cleared every loan, whatever remains belongs to you. That remaining value is your equity. So exactly the same principle applies to listed companies. A company with growing shareholder funds is generally building value for its owners. But here is something important. Growing equity alone doesn't automatically make a company a good investment. Now ask, is it growing because it's making profit or because it keeps raising money from shareholders? That's an important distinction. Now, a practical exercise. Number 1, visit the investors relation page of one of the NSE listed companies. Download the last 5 annual reports. Write down the shareholders' funds for each year. Don't worry about understanding everything yet. Just look for the trend. Is it rising, flat, or falling? That's your first clue about the business. Number 2, market capitalization. People often ask, what is the biggest company on the NSE? The answer isn't based on the price of one share. It is based on market capitalization. Now, market capitalization equals share price times the total shares outstanding. Now, let me just break it down for you. Imagine two bakeries, okay? Bakery A has 100 ownership units worth 100 shillings each. Its total value is 10,000 shillings. Then there is this bakery B, which has 10,000 ownership units worth 50 shillings each. Its total value is 500,000 shillings. Even though each unit costs less, bakery B is much larger. That's exactly how market capitalization works. It tells you the market current valuation of the whole company, not whether it's cheap or expensive. So practical exercise 2 that I would really love you to do. Open an NSE website or your broker platform. Write down the market capitalization of Safaricom, Equity Group, KCB Group, Cooperative Bank, EABL. Notice how different they are. Number 3, the PE ratio. That is the price to earning ratio. Now let's talk about one of the most quoted numbers in investing, the price to earning ratio, or the P/E. Think about buying a rental apartment, okay? We are thinking, suppose you pay Kenya shillings 10 million. It earns 1 million shillings a year in profit. Ignoring taxes and maintenance, it would take about 10 years to earn back what you paid. Okay? And that's the intuition behind the price to earning ratio. A lower price to earn ratio can suggest a company is valued more cheaply relative to its current earnings. And a higher price to earning ratio can indicate investors expect stronger future growth. But here's the catch. Never compare companies from completely different industries. A telecom company, a bank, and an agricultural business operate under different economics. So instead, compare business within the same sector. And when we say within the same sector, if it is in agriculture, it's agriculture. If it is telecommunication, telecommunication. If it is banks, it is banks. Don't take a bank and a telecommunication because the operation differ. Now, practical exercise number 3 that I would really love you to do, choose 2 banks on NSE. Compare the price to earning ratio, okay? Then profit after tax, and then return on equity. Then ask yourself, why is it that one will trade at a higher one than the other? Ask that question. And then we go to number 4, return on equity, the one they call ROE. Yes, we call it like that. So imagine 2 business owners. Now, each one has 100 million invested. 100 million each business owner, okay? Now, owner A earns 20 million shillings, owner B earns 8 million shillings. Who is using capital more effectively? It's owner A, because he's using 20 million. Okay? That's what return on equity measures, the earnings that you get. So, it asks, how much profit does management generate for every shilling of shareholders' equity? A consistently healthy return on equity can indicate that management is using investors' capital effectively. But always look at it together with the debt levels. Very high debt can artificially inflate the return on equity. And then number 5, debt. Debt isn't automatically bad, by the way. Many successful companies use borrowing to grow. So the real question is, can the company comfortably service that debt? So look for, 1, is debt increasing faster than profits? Are interest costs consuming earnings? Does the company still generate healthy cash flows? Those are some of the crucial questions you need to look when you're looking at the debt of the company. And number 6 is the dividends. I know you have heard that term for many things. The ones who have been in circles, chamas, they always talk about dividends. So many investors love dividends. But remember, a dividend is simply part of a company's profit distributed to shareholders. A company that pays smaller dividend isn't necessarily worse. No. It may be reinvesting profits to grow, like it is getting those dividends and then bringing them back to the business. So your job is to understand why. And now number 7, do you understand the business? This may be the most important question of all. If you can't explain in simple words how a company makes money, you probably shouldn't invest in it yet. For example, how does Safaricom make most of its revenue? Do you know? How does a bank earn income? Do you know? What risks does an agricultural company face? Understand the business model helps you to stay calm during market when it's up and it's down. Like you actually understand how it is running. So the final checklist before buying any company, ask, does it make consistent profits? Are shareholders' funds growing over time? Is the debt manageable? Is the return on equity consistently healthy? Is the price to earning ratio reasonable compared with similar companies? Does it have a sensible dividend policy? Do I understand how this business actually makes money? If you can't answer these questions, don't rush. Keep learning. The stock market isn't a race. It's a journey of becoming a better business analyst. Now, homework. This week's challenge. Pick one NSE listed company, then create one-page profile. That is the shareholder funds, the market capitalization, revenue, profit after tax, the price to earning ratio, the return on equity, dividend per share, and the total debt. Don't decide whether to buy it yet. Simply practice reading the business, because the investors who build wealth aren't the ones who move the fastest. They're the ones who actually understand what they own. And you can download our today's investor checklist for free in the description. It's complete while you're watching this video, and you can start thinking like an investor, not like a gambler. So it will help you when you're analyzing this. Don't forget to like, subscribe, and share this video with everyone, and I'll see you in the next video.